Hi everybody and welcome back to the channel. Do you want to avoid some of the most common mistakes that new investors make when they start their investing journey? In the next few minutes, I'll share 5 of the key mistakes that loads of new investors make when first starting out, and I'll share some tips on how you can avoid doing that too. Let's jump in. First up is fee blindness, and I've talked a lot about this on the channel over the last few videos. Fees may look small on paper, 0.1, 0.2, maybe even 0.5%, but these compound over time. Vanguard and other major firms spell this out. Costs may seem tiny year to year, but over decades they can shave thousands off of your final investing pot. For example, if 2 investors earn 7% over 30 years, yet one's paying a 0.2% fee and the other one's paying a 1% fee, the low fee investor can make significantly more over that time horizon. I talked around this in my most recent video looking at my 6-fund portfolio. You can catch that video up here if you want, but I'll show the breakdowns of different investment horizons over time using £30,000 on screen. So you can see actually it's not small amounts, it's not just £100 here. You're making thousands of pounds extra just for that small difference. So key actionable things that you can do when investing is to check the ongoing charge fee of any of the ETFs that you invest in. There's a range of low-cost ETFs with fees ranging from 0.07% up to kind of 0.22%. But there are also other options that charge significantly more than that. It's also important to consider the platform's account fee. I've recently moved to Trading 212, which charges absolutely nothing to hold my ISA there, whereas some of the older platforms like Hargreaves Lansdown, Vanguard, and even Freetrade do charge account fees. Some of the fees we can't avoid are FX fees for when we buy stocks outside of the UK, and also things like stamp duty, which is just a given. But for your ongoing charge fee and your platform fee, you can shop around to find the best fit for you to really reduce down those fees. Mistake number 2 is chasing hot tips, and I think everybody's a little bit susceptible to this when they first start out. People see a big winner, lots of hype on social media, and jump in late, or sell everything at the first day of red. And this is due to inexperience and wanting to chase big wins. Historical data shows that active fund managers actually fail to outperform the market. So it's tough even for professionals to time winners. So if you're brand new, it really is going to be pot luck. For example, you get a notification on Trading 212 to say that a stock has jumped 150% today and you don't want to miss out. So you pile capital into that stock and then find that over the next month to 3 months, it pulls back 50%. You're sat there holding the bag whilst everybody else who was in early is made significant gains. Emotional buying is the fast track to making losses. Sometimes the best thing you can do is listen to yourself and close your ears to everybody else out there. The way we can fix this is by setting yourself a long-term plan. Whether that's ETF investing or individual stocks and shares investing, you can stick to that no matter what's going on in the environment and the market around you. Personally, I set a core portfolio of diversified ETFs and diversified stocks. I dollar cost average into all of these stocks and ETFs every single month, and I largely ignore the headlines. Evidence supports that time in the market is better than timing the market. And whilst you might have some great successes by getting into a stock at the right time, that over your entire lifetime of investing is not necessarily going to happen every time. And the position you don't want to be in is where your losses outweigh your wins. Mistake number 3 is ignoring the tax wrappers available to you in the UK. Not every country has a stocks and shares ISA that gives you £20,000 tax-free every single year that you can invest. So we're in a really fortunate position, and in the UK, ISAs and SIPs are there for exactly that, to protect you from tax. If you hold investments in the wrong account, you will be liable for more capital gains tax and dividend tax than you need to be. The use of stocks and shares ISAs is now increasing, but there's still a really low percentage of people in the UK who've actually accessed them. I was speaking to a subscriber just a few weeks ago who said they didn't want to open a stocks and shares ISA because they wanted to put their emergency fund into a cash ISA. Now, they weren't saving anywhere near £20,000 a year into their cash ISA. So really, they could have split that allowance to invest both in the stocks and shares ISA to protect themselves from tax, but also save into their cash ISA for their emergency fund. It's key, therefore, to prioritise your stocks and shares ISA and your pension pots to protect you from tax as much as possible. If you run out of allowance, or you just don't want to save into a SIP as well, then you can move across to a general invest account. As always, nothing I talk about today is financial advice. These are just things that I've picked up on to implement into my own investing journey from speaking and seeing how different people manage their money. Mistake number 4 is poor diversification. And by this, I mean investing all of your capital into just 1 or 2 individual stocks or sectors. Diversification reduces the risk that either a sector or a stock will pull back over time and smooths returns across multiple sectors, geographical regions, and different stocks and shares. There is some pushback on this, with people advocating for hyper concentration on a small proportion of stocks. However, personally, that's a risk that I'm not happy to take. And I found that when starting, investing in broad market indexes and a selection of different stocks and shares gave me the security and meant that I didn't have to keep up to date with all of the news about everything going on all the time. There are people who are heavily invested in things like Nvidia, Tesla, but as we've seen over recent weeks, individual stocks and shares are susceptible to large pullbacks. So if you're worried about this, there's a really easy fix, and it's to develop a diversified portfolio of ETFs or stocks and shares which go across the broad market range. There are also some fantastic pies on Trading 212 which invest in individual stocks and shares but are really broadly diversified. So you can check them out in the community pies as well if you're interested. And finally, mistake number 5 is emotional trading, similar to mistake number 2 around chasing the market. As humans, we're not designed to invest for the long term or consider long-term prospects. Evolutionary, we're driven by fear, greed, and self-preservation. Us humans now live in a far more complex world than we did through our evolutionary experience. And finance behaviours show biases like loss aversion and overconfidence push people to sell low and trade excessively. A prime example of this would be going back to April earlier this year. Everything pulled back when Trump opened his mouth. For seasoned investors, we know that this is just part of the market cycle, and history will tell us that things will get back to normal at some point in the future if you've got a long enough investing horizon. However, if you're brand new and you've put lots of money into investing, you could panic, sell out, and then miss the market rally, sitting there with a significantly reduced pot to where you could otherwise have been. Missing just a few of the market's best days can drastically reduce long-term returns. There are a few things that you can do here. One, if you're a long-term investor, just don't check your investing account. If you've got a long-term time horizon and you know that you're not going to want this money for 30 years, looking at it and worrying yourself isn't going to do you any favours. Equally, if you automate investing as much as possible, it reduces your potential drive to sell at times of market instability. That's obviously not saying don't sell. Maybe it is the right time to sell for you. The key here is to not make a snap emotional decision that goes against your investing targets. It is difficult, it is tough, and that's why I made the decision to invest in ETFs primarily over individual stocks and shares. So there we go, the 5 mistakes that loads of new investors make. And here are 3 key actions that you can take away from this video. Number 1 is to check the ongoing charge fee of any ETFs you're currently invested in and the platform fees that you're currently paying. Number 2 would be to automate monthly investments as much as possible. This reduces potential desires to sell emotionally. And number 3 is to consider whether you're utilising your tax wrappers as effectively as possible. These 3 alone may protect potential returns and reduce your stress. If you found this useful, please do like the video and subscribe to the channel. And if you've made any of these mistakes previously when you started out investing, drop a comment down below to let me know exactly which ones you make and how you rectified them. But as always though, thanks for watching, happy investing, and I'll see you in the next one.